In many ways, Amazon.com is perhaps the company that is most closely tied with the e-commerce phenomenon. The Seattle, Washington-based company has grown from a bookseller to a virtual Walmart of the web, selling products as diverse as music CDs, cookware, toys and games, and tools and hardware. Amazon is one of the first companies to sell products deep into the long tail by housing them in numerous warehouses and distributing products from many partner companies. The majority of Amazon's sales are products sold by Amazon, though many are from third-party sellers. Since 2004, Amazon has begun to rapidly expand its web services arsenal. As of the first quarter in 2011, Amazon has approximately 137 million active customers worldwide. It was also reported that there are 2 million merchants selling on Amazon, equaling a third of the total listings. North America currently represents 55.4% of sales, with the other 44.6% in the international market. Because Amazon is primarily a retailer, business can be seasonal, so comparing the balance sheet from quarter to quarter doesn't always work. However, when quarterly comparing Amazon's balance sheet at the end of its third quarter in 2012 with the end of the third quarter in 2011, we found the following. The total of cash and marketable securities fell by nearly $1.1 billion to about $5.25 billion over the 12-month period. Working capital went from $2.92 billion to just $513 million. The current ratio went from 1.33 to 1.04, and the debt liabilities to assets ratio went from 59.24% to 66.92%. When comparing the balance and income sheets, there certainly are trends that just don't look good. The following chart shows Amazon's working capital at the end of each quarter. The dollar values on the left are in millions. 18 months ago, at the end of 2011's first quarter, Amazon had nearly $3.56 billion in working capital. That number was down to just $513 million at the end of September. Year over year, Amazon has seen their bottom line shrink from a gain of $631 million to a loss of $39 million, despite an increase in revenues from $48.1 billion to $61.1 billion. An increase in the percentage of sales devoted to SG&A costs from 14.28% to 15.92% was a key component in the falling bottom line in the face of rising revenues. The following table shows Amazon's current financial ratios, which includes its return on assets, ROA, and return on equity, ROE, for the last 3 fiscal years alone. As you can see, Amazon's ROA was fairly low in 2012. In fact, it was uncommonly negative. During this year, Amazon.com was spending more than it made. The ROA has been decreasing from 2.5% in 2011 to a negative 0.12% in 2012, and surfaced into the positives in 2013 with 0.31%. Amazon had its most profitable year in 2008, but it also increased its assets by 125%, dragging down the ROA to 8.7%. These numbers indicate that Amazon is good at turning its assets into revenues. Perhaps they should take notice. Comparing Amazon's ROA and ROE to its industry ratios, you can see that Amazon has recently been beating the retail industry's averages. However, taking a closer look at Amazon's financials shows that the company took on a lot of debt, which can inflate ROE. As an online company, Amazon has less physical assets than other retailers with store locations, which could account for the high ROA as compared to other retailers. In this case, it would be useful to compare Amazon's ratios to another online retailer with a similar structure. As of March 31st, 2013, Amazon.com had cumulative 12 months free cash flow of $177 million, compared to a free cash outflow of negative $2,627 a year ago. Amazon achieved highest trailing 12-month year-on-year free cash flow growth, while total ranking has improved so far to from total ranking in previous quarter at 423. This year, cash flow per share from operating activities is expected to rise 65% to 10.68 from an estimated 6.48 in 2012, according to data compiled in Yahoo Finance. Operating cash flow is what a company spends on regular business operations, which can include depreciation, amortization, and changes in working capital. Free cash flow excludes capital expenditures. Operating cash flow increased 39% to $4.25 billion, compared with $3.05 billion for the trailing 12 months ending in March 31st, 2012. Free cash flow decreased 85% to $177 million for the trailing 12 months, compared with $1.15 billion for the trailing 12 months ending March 31st, 2012. Free cash flow for the trailing 12 months ending March 31st, 2013 includes fourth quarter 2012 cash outflows for purchases of corporate office space and property in Seattle, Washington of $1.4 billion. Operating income decreased 6% to $181 million in the first quarter, compared with $192 million in the first quarter of 2012.
The safest investments tend to be in the bond market. Based on its risk, you usually see very low coupon or interest rates on bonds. Treasury bonds tend to be the least risky because the U.S. government backs these bonds and there's a small chance they will declare bankruptcy. Municipal bonds are issued by local governments and agencies and will have a slightly higher coupon rate because the risk is higher. For example, San Bernardino declared bankruptcy as a city. They were unable to pay their bonds, and this forced them to default. The next bonds are corporate bonds, and these are issued by businesses to raise capital. These tend to have the highest coupon rates because the risk is higher for the investor. Corporate and municipal bonds are rated on a scale which includes A, AA, and AAA, among others. AAA is the highest rating and means that these chances of payment on time and in full are very likely, thus creating smaller risk for the investor. Amazon does not have a lot of bond debt, but according to Morningstar, they carry around $3 billion in 3 separate bonds. The first matures in 2015 and is $750 million with a coupon rate of 0.65%. The second matures in 2017 and is $1 billion with a coupon rate of 1.2%. The third matures in 2022 and is $1.25 billion with a coupon rate of 2.5%. Amazon's credit rating according to Morningstar is an A-. This is a very good rating for a corporate bond and can show probability of payment. The only downside is that the net income for Amazon showed a negative for the fiscal year of 2012. They did, however, have a total revenue of $61 billion in 2012, which showed some promise. Amazon's main competitor is eBay. Amazon carries around $3 billion in bond debt, while eBay carries around $4.5 billion. eBay and Amazon sold similar bonds which expire around the same time. However, eBay's bonds have a higher coupon rate than Amazon. Amazon's bonds that mature in 2022 have a coupon rate of 2.5%, while eBay's is 2.6%. Also, Amazon has a bond that matures in 2017 that has a coupon rate of 1.2%, while eBay's is 1.35%. eBay had far less revenue than Amazon did in 2012, which could lead to the difference in coupon rates. Also, Amazon has a debt-to-asset ratio of 10.71%, while eBay has a debt-to-asset ratio of 11.8%, meaning for every $12 of debt, there is $1 of assets.
CAPM stands for Capital Asset Pricing Model. The equation is risk-free rate, which you get from the U.S. Treasury bonds, plus beta, or equity betas, which is a stock's market risk or how sensitive the stocks is to fluctuate in the market, times the market premium, which is the average return of the market, minus the risk-free rate. Our stock is Amazon. The risk-free rate is 0.025. The beta, which is 1.135, times the market risk premium, which is 0.077, and finally subtract the risk-free rate of 0.0225. This gives us a return required by investors on common stock of 0.084 or 8.4%.
As part of our analysis, we evaluated the historical growth rates in revenue, net income, and book value. We also looked at the return on invested capital to evaluate how well the companies were using their financial resources to generate returns. Finally, employing a very subjective analysis, we ranked Amazon by comparing it to the other companies first. Can Amazon do it forever and pay its suppliers always even later, unlimited number of days, or in other words, stop paying its suppliers and getting the stuff for free? No, of course not. Therefore, when using a free cash flow multiplier method to value a business, one has to normalize the free cash flow before calculating the multiplier. Amazon's way of speeding up free cash flow faster than revenue growth is not sustainable. Further, a free cash flow multiplier of 27 is insane. At least for economic reasons, this implies a 3.7 pre-tax cash return for the investor. By any economic measure, the stock Amazon does not reflect the economic value of the company Amazon.com. The company is worth much less.
The weighted average cost of capital, referred as WACC, is the rate that a company is expected to pay on average to all its security holders to finance its assets. The WACC is a minimum return that a company must earn on an existing asset base to satisfy its creditors, owners, and other providers of capital, or they will invest elsewhere. Companies raise money from a number of sources. Example: common equity, preferred stock, straight debt, convertible debt, exchangeable debt, warrants, options, pension liabilities, executive stock options, government subsidies, and so forth. Different securities which represent different sources of finance are expected to generate different returns. The WACC is calculated taking into account the relative weights of each component of the capital structure. The more complex the company's capital structure, the more laborious it is to calculate the WACC. Companies can use WACC to see if the investment projects available to them are worthwhile to undertake.